I think if we looked at the Fed's framework that they've repeated in statements over the last 8 meetings about data dependence, then they should have cut, or they should be cutting in July. So I think this last meeting seemed to have changed the guideposts from data dependence to forward-looking expectations around tariff inflation that I think is why markets are starting to question the Fed's rationale. And Professor Siegel points it out, long-term inflation expectations are lower today for 1 year forward than they were in December. So we've gone through a full tariff liberation day and expected inflation's lower. Yields are actually lower. I think the market is moving ahead of the Fed and saying the Fed should be cutting sooner. I might add that I think interest-sensitive groups are going to benefit because they're going to start to look forward and realize the Fed, if they are a little slower this year, they're going to be more dovish next year. That's good for financials. It is good for the industrials, really good for Bitcoin and small caps as well.
Tom Lee opens with a data-driven challenge to the mainstream inflation narrative. The May CPI report revealed core inflation rising just 0.13% month over month. But Lee digs deeper, removing housing and auto insurance from the equation. The broader economy is actually experiencing deflation. He points to falling goods prices, driven by easing supply chains and shifting global trade dynamics. While headlines still focus on sticky inflation, the underlying trend suggests something very different, a cooling economy that markets may be underestimating.
And before that, be the one who says, I was here before 100K. I'm on a mission to hit 100,000 subs before 2025 ends. Help me get there. Subscribe now and drop your thoughts on the market in the comments. Let's grow and win together.
One of the things that I think helps is if you go to the May CPI report, core inflation was 0.13% month over month. The goods component was in deflation, which is affected by tariffs. And then if you look at core, the two biggest contributors were housing and auto insurance. That was 0.14. So outside of housing and auto insurance, we had deflation in the May CPI report. I don't think tariffs are going to cause housing prices to go up, nor is it going to cause auto insurance. So to me, the Fed is, I think, shifting to looking at expected tariffs, but not realizing the real driver of inflation. 75% of inflation since 2019 was housing and auto insurance. Those are both actually starting to cool.
So, Tom, do you agree with that? I mean, you agree that Waller might be jumping the gun here with calls for July?
I think if we looked at the Fed's framework that they've repeated in statements over the last 8 meetings about data dependence, then they should have cut, or they should be cutting in July. So I think this last meeting seemed to have changed the guideposts from data dependence to forward-looking expectations around tariff inflation that I think is why markets are starting to question the Fed's rationale. And Professor Siegel points it out, long-term inflation expectations are lower today for 1 year forward than they were in December. So we've gone through a full tariff liberation day and expected inflation's lower. Yields are actually lower. I think the market is moving ahead of the Fed and saying the Fed should be cutting sooner.
So at what point is the market going to get, Tom, too upset by the pace that appears to be slower than it would like?
Well, there could be an accident, right? Because I think what we are ignoring is housing is choking and collapsing under the weight of higher interest rates. And the labor market isn't as strong as it appears. I mean, when we look at the ability to get a job, it's much harder. So as Professor Siegel says, there's long and variable lags. There could be an accident where the Fed will have to panic. So I think that's something we have to watch in the incoming data.
When you say accident, what do you mean? On the long end of the curve, like rates go up too much? What do you mean?
No, I think that there could be a point where the Fed suddenly realizes the risks are actually to the downside for the economy weakening. And so the Fed will actually have to respond to an economy that they're strangulating and really fighting what they believe is a supply shock inflation. So I'm a little concerned that the Fed could be late if they continue to hold.
Adds to the uncertainty, the Fed's roadmap and the Middle East, you throw that into the mix too. We're not really sure what's going to happen there. What's your best idea now in light of all that?
Best idea is still AI. AI has run, but it's still, if you're looking 12, 24, 36 months out, it's still that AI trade. This is not like the late 90s. The player's not like the late 90s. The opportunity's not like the late 90s. This has legs. The AI diffusion, the Mitigation of AI Diffusion Act has given it legs. And we will continue to see AI. That is the U.S. secular robust trade. That is the trade that you need to be in if you're not in already.
Tom, you guys sound like you're sharing research.
Yeah. I mean, I broadly agree. I might add that I think interest sensitive groups are going to benefit because they're going to start to look forward and realize the Fed, if they are a little slower this year, they're going to be more dovish next year. That's good for financials. It is good for the industrials, really good for Bitcoin and small caps as well. I mean, I think companies have proven many times over the last 5 years that they are incredibly resilient and adaptive. This is really the fifth shock that they've absorbed. I do think one of the consequences of sort of surviving COVID and fastest hikes in history and now this tariff shock is that investors are going to start to assign higher multiples to the companies that are succeeding. So I do think PE expansion is a theme we should think about the next 12 months.
Tom Lee attributes the resilience of U.S. markets to the key forces, strong consumer participation, and the ongoing AI infrastructure boom. Despite internal political division and global uncertainty, markets continue to climb, driven by the reality that there are few compelling alternatives and that as the innovation and capital markets still lead the world. Lee's broader message is one of cautious optimism. While inflation concerns, interest rate uncertainty, and geopolitical risks persist, he sees tremendous upside, especially for investors who can step back and grasp the larger macro and technological shifts already underway.
Listen, I think the big question is the president going to appoint a shadow Fed chair, right? There's a lot of talk that he's going to, already kind of semi-nominate someone, 9 months, 12 months in advance of when Powell steps down. That would be, I think, not warranted or not wise. I think it would create a really steep yield curve, right? People will like, wait a minute, if we're going to kind of give up Fed independence or going to start pressuring that, right? And so I think Powell's done a really admirable job of just holding the line on Fed independence. President can say whatever he wants. It's not going to affect what Powell's doing. The moment that gets questioned for real, and there's pressure on the Trump administration to actually do this. I think that could be very, very negative for markets. The dollar would sell off pretty tremendously. Yield curve would steepen. And so we'll see. It hasn't happened yet. Trump loves a lot of bluster, and we'll see if they go that next step. But I think that next step would be a really, from a macro trader, it would be easy. You would just sell more dollars and put on more yield curve steepeners. But I think it would be very bad for the country. Again, for academics or for pundits to comment on, is Powell making a mistake or not? That's what we all do, like macro traders do, economists do. When it's seen being directed by the president, it's one step closer to no Fed independence, right? And listen, the people you hear names kicked around, Scott Bessent moving to the Fed. There's no way Scott Bessent is going to be, a Fed chair at the behest of doing whatever the president asks. It's just not who he is. Same thing with a lot of the candidates. And so, it will be hard for them to find a credible candidate that will do what the president wants, right? Almost by definition. And so I just think the closer you get to losing Fed independence, the worse it is. It certainly would. Like the long end, 30 years, 10 years would sell off, not rally. And I think everyone who's been in, the study of macro for a long period of time, you see other countries have tried it. I mean, Erdogan did it in Turkey and it was a disaster. And so listen, I think the kind of names getting kicked around would never do it, right? Kevin Warsh, there's no way he's going to take the Fed chair and do what the president says. They're going to define their independence. And so I have faith that we're going to continue to have independent central bank. And part of this is politics, right? President Trump is a master at politics, right? And so like him having someone to blame is a good thing from him from a political perspective.
Mike, what is the trade? You had mentioned a little earlier that, this doesn't bode well for the dollar and the long bond could be under pressure as well. The 10-year, we're looking at it around 435 today. Realistically, where do you think it goes? And as a macro trader, would you go really short? Would you take that pain?
Listen, if I thought we were going to lose Fed independence, I would be limit short the dollar and limit short long bonds. I don't think we're going to lose Fed independence. I really don't. I think, like I said, I think Trump likes to bluster about this stuff, but I don't think he's going to cross that red line.
What do you think will happen to risk assets if President Trump joins Israel in support of an attack in Iran? If we contribute bunker busters, if we contribute actual troops to a full-blown war, how does this market, which has been pretty good at ignoring geopolitical issues over the last few years, how does this market then react?
Yeah, it's a great.
While we're throwing up hypotheticals, Mike.
It's a very difficult question. I think, listen, if we went with bunker busters and took out the one big facility that everyone's talking about, the immediate reaction would be oil up, stocks down, probably even dollar stronger, just because people are short the dollar and people want to get out of risk. I think Trump would only do that. Like, when I'm thinking through the logic, if he would then say the war is over, Israel stand down and have a prearranged agreement with Israel that, like, we'll take out that one facility and then that's the end of the war, and say the same thing to Iran and try to declare peace at that point, that could be wildly bullish. It's an unbelievably tricky situation. If we just enter the war and it's protracted, categorically bearish. But if it's a one strike declare victory, it could, actually be the exact opposite. The stock market has been a conundrum to people because it trades spectacularly well, despite what seems to be all kinds of geopolitical issues and internal issues, right? Between tariffs and wars and this, the fights between, Trump's parade on one side and the No Kings parade on the other, right? All this discord, the stock market keeps chugging along. Partly that's because unemployment stays low and retail continues to be a participant. I think partly because of this giant data center build, right? This huge infrastructure AI build that's happening, which is adding incredible amounts to GDP. I've come to realize that despite bad government, we have such amazing capital markets and such an amazing entrepreneurial class that it's kind of holding off what feels to be all this, uncertainty. And so stocks don't feel like they want to go lower. Everyone I know has been underweight them, think they're overvalued. They trade like they want to go higher.
He reminds us that the U.S. economy has weathered a series of major crises over the past 5 years. From the pandemic and inflation surges to escalating geopolitical tensions, and yet, it hasn't just survived, it's adapted. That resilience is now being rewarded in the markets, and Tom Lee believes it will continue to be. In his view, the real risk isn't external shocks, it's policy missteps or political interference. But as long as the Fed maintains its independence and the AI-driven growth narrative stays intact, Lee sees a strong case for the U.S. markets to remain firmly on a bullish path. The next big move is coming. Watch this video to stay ahead.